This short clip is presented by Edge. Edge is our pro-to-pro advisory service, which is all about the macro with a focus on one-to-one engagement with the hedge fund manager, Craig Shapiro, economics advisor, Jeffrey Fouvry, and direct access to LaDuc Trading founder, Samantha LaDuc. For more information about Edge, visit www.laductrading.com/edge.
Hey, greetings, and thanks for joining us. This is Macro to Micro Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by our macro advisor, Edge manager, Craig Shapiro. And we just had, a lot of events this week. Not only 175 companies in the S&P are reporting, but we had the QRA quarterly refunding announcement by Yellen Monday with her composition breakdown this morning at 8:30, as well as FOMC statement and then Powell presser. And we got a lot to dig into. So I am going to just throw it right over to Craig first and foremost to kind of give us a rundown of all that TGA and QRA activity, and then we'll move to Fed. No hike, no cut, not a surprise, but the dollar did dump, markets did pump, and then they did a complete 180 right before the close. So we're going to talk about that dollar. Take it away, Craig.
Thanks. It's good seeing you. There is a ton going on, and we've been talking a lot about it throughout these weekly calls and in our Slack channels and in the room that you host every morning, and Twitter and everywhere. And so, look, I wrote up a post this morning, which kind of talked about this idea of the put, right? The Fed put and the Treasury put, and it's this idea that when markets are reeling for whatever reason, we search for levels where the Fed may react, or when the Treasury may react to market pricing, to levels of volatility, to an adverse, risk asset scenario. And so, look, coming into the week, markets had started to show signs of sluggishness, right? April was not a particularly great month for risk and for equities and or for bonds, as yields have been rising, as we have seen better than expected data, a labor market that remains fine, inflation that's been running hotter than expected, and the need for the Fed to talk about removing the rate cuts. And we also had and also know that the fiscal deficits in the US are not really getting any better. Treasury has a lot of debt to sell forever. And so the question was, how much are they going to sell in bonds versus bills, this for the next 3 months. And so as the markets were kind of sliding, I think there was a growing belief that perhaps Treasury would enact its put this week. And what I mean by that is, people were thinking Yellen, more of a political animal, trying to get the administration reelected, could do certain types of things to help pump money into the economy. She could or would run down the TGA account. She would issue more bills than bonds, even though term premiums have been muted and the yield curve is inverted. And she should be issuing more duration, and said she'd be issuing more duration. People were thinking, look, with the bond market selling off, she's going to come in here and do something about it. And so she was up first. On Monday at 3:00, what we got was really the opposite of the pump. We got an announcement from Yellen that not only will she raise the amount in the TGA by $100 billion for the end of the third quarter, so taking that number up to $850 billion from $750 billion for the third quarter, suggesting that she's not going to be putting money into the economy. She also told us that tax receipts really had not been coming in as strong as maybe people were thinking. And so the borrowing needs for the second quarter and for the third quarter came in well above what people were expecting. And forget the number for the second quarter, the 40 billion or so from what she had told us a quarter ago. And the range of estimates that I saw for the third quarter were around 550 to 650 billion. She came in at 850 billion. Now, 100 billion of that is the TGA ad. So still 750 billion. It's way higher than what anybody was thinking, which suggests that tax receipts really didn't come through like people were thinking, and that there's incremental spending. We know that the administration just passed another spending bill for foreign aid to the tune of about 100 billion. So part of that gets spent this year. So look, there was way more borrowings coming for the third quarter, and a TGA bump up really meant that Yellen was not going to be pumping. And so we did still need to get through to this morning at 8:30 in order to determine the bills versus bonds composition. But what I had been telling people in the room was that this was enough data for us. We got what we needed to hear coupons are not going to be cut, which had been an expectation for the market coming into the week. There was just too much borrowing that needs to get done. And so what we got this morning was that announcement. We got a continuation of the elevated levels of duration supply issuance. Now, there was not an increase in the coupons, but no one was expecting an increase in the coupons. People were thinking the coupons are going to be cut. So the fact that it came in kind of flat versus the prior 3 months, that was as bad as hawkish an expectation, I think, as we should have expected. So Yellen, as of this morning, is going to be selling, 500 billion or so of duration issuance for the next 3 months. There was a token Treasury buyback announcement to the tune of 30 billion, which, look, yeah, on the margin, is it incrementally? Does it incrementally put some liquidity into markets? Sure, but the numbers are infinitesimal. For a Treasury that's borrowing, $1.1 trillion of gross issuance this quarter. So it's just really not such a deal. And so I thought that Treasury's announcement really was the put is lower. The strike prices for the Treasury put are lower. Yellen did not feel the need to really give the market a reprieve from what it had been seeing over the course of the last, let's call it 6 or so weeks, which is term premiums moving higher, yields moving higher. And she basically said, we're going to keep doing what we said we were going to do. Now, she also said that they don't expect to be increasing coupons for the rest of the year, but possibly start to increase them again in 2025 or 2026. So that's again the way that they start to introduce this idea that, well, maybe it's possible that we'll have to if the deficit continues to rise, if borrowings go up, if tax receipts disappoint. So you could say that she is kicking the can a little bit past the election. She doesn't want to raise coupons even further before the election. I guess that's in her right to do, even though it's for not great for the long-term borrowing capacity or needs of the country. But so be it. So I think from the Treasury point of view, the put is lower. More supplies are coming. Bond markets should continue to sell off. Term premiums are likely to keep rising, and that's going to continue to apply pressure on risk assets. So
well said.
That took us through the kind of saga around Treasury. We can get into some of the more details, But then we got to 2:00 with Powell. And look, I think I've kind of mixed feelings about how what was said and what was not said and what I thought might happen and what didn't happen. I thought that, for one, he would be hawkish. I thought the statement would be hawkish. And look, the truth of the matter is the statement was hawkish because the statement talked about the fact that momentum on inflation really had been deteriorating since the beginning of the year. So to me, that was him slamming the door on rate cuts, basically saying, look, we're really nowhere closer. We're actually probably further away at the beginning of the year. And so don't really think we're going to be cutting rates this year. He did introduce QT tapering. I thought that was probably a coin flip. I thought it was more likely he would do it next month. He decided to do it this month, but it starts in June. So versus if he started it next month, it would have started in July. So it's only 1 month, 1 month sooner than I guess I would have expected. Some people were thinking he would cut or taper 30 billion of treasuries. He did 35 billion. So again, these are marginal numbers. The idea of tapering is not really to provide more liquidity into the markets. It's really to kind of, by slowing down the pace of balance sheet reduction, they feel they're less likely to have a financial accident at a variety of banks that have a more suspect reserve situation. And so by slowing down tapering, it's less likely we're going to have some sort of crisis, but that will allow them to taper the balance sheet. Do more QT for long and bring the ultimate level of the Fed's balance sheet down to a lower level. That was the intent. Clearly, people think that is, very stimulative. And look, it's hard to say, why is the Fed being hawkish in the statement on rates and then being dovish on the balance sheet? There's a little bit of a mixed message there. Powell was asked about it. I don't really think he gave a very good answer, but it is what it is. Now, was
there a handshake potentially for Treasury with her announcement in regards to the QT?
I mean, maybe. Who knows? I think there, when you go through the minutes of the T-back report, it said, all the primary dealers basically expected tapering either at the May meeting or the June meeting. So, and I guess a couple at the July meeting. So it was in the price, it was just a question of when, so yeah, I think maybe on the margin, given markets were a little bit struggling, maybe Powell said, this is probably not a bad time for us to at least break this out here, so investors don't think we're just super dumb.
Okay.
Then on the conference call, on the press conference, as he was reading the press conference, he goes through a set of prepared remarks, and you could compare the prepared remarks. You can read along with his prepared remarks from last meeting while he's reading. And the thing that he said, which I thought was interesting, and really nobody really talked about it, is that he removed the phrase. I'm just looking at my notes here, but he removed the phrase from his prepared remarks, quote, "We believe that our policy rate is likely at its peak for this tightening cycle." So when I saw that, I was like, okay, like this is more hawkish. This is the Fed kind of maybe saying, look, he's introducing the idea that it's possible that rates may have to be raised again. And that what I've been saying in our chat channel and our chat, the public domain, is I think that the Fed needs to introduce a more dual-sided approach to monetary policy. They need to be as willing to raise rates as they are to cut rates at this point, and because that would really go a long way towards dampening animal spirits, towards allowing term premiums to move higher, to reducing inflation expectation, and ultimately, getting to that last mile on bringing inflation back.
So tightening financial conditions through equity correction in order to get inflation back down.
Yep. So when I saw that,
not what he said.
So when I saw that phrase in the prepared remarks, I was like, okay, this is what I expect. And then basically every question that he got about whether or not the Fed was willing to entertain a rate hike, he basically said, it's really not our base case, really not likely, still has a bias towards easing, and really wanted to talk more about the scenarios that would exist that would bring back in the rate cuts, as opposed to scenarios that could exist that would necessitate rate hikes. So he still is asymmetric. Now, there are various hawks on the Fed, which we've talked about, who are certainly, I think, going to push back against another dovish performance by Powell and give more data behind what they would need to see from the actual data, to say, look, I think we should be hiking here. Now we'll get another round of dots at the June meeting. It's possible that's where we'll start to see first evidence that there are members who expect a hike later this year. Hard to say, but I imagine, given where markets are pricing now, we're going to see, the median expectation for this year is going to move probably to one cut, and we'll probably take a couple cuts out of next year too. So, look, I think if you kind of step back holistically, you look at that, what he said was inflation's moving further away from target. That means we're going to be higher for longer. I think he needs to go further and say rate hikes on the table in order to keep the animal spirits down. But maybe it's the case that because of what Treasury is doing, that's enough to keep animal spirits at bay. And so he didn't feel like he needed to kind of introduce even more volatility. We'll see how the markets reacted. Obviously, the initial reaction was gold up, Bitcoin up, stocks rip, financial conditions ease mightily, bonds rally. And then look, we know in a negative gamma regime like we're in right now, that buying begets buying. And so kind of markets went crazy. And then as we kind of got, further to the end of the day, some of that started to unwind a little bit. The bond market found its footing, and the long end started to sell off again. And actually it looks like, I think now yields on the 30-year are high. Yes, yields on the 30-year are higher than they were at 2 p.m. And yields on the 10-year are basically very close to where they were at 2 p.m. So the bond market, really said to Powell, either A, if you're going to do this and be too loose on inflation, that's a reason to sell off bonds, or they said, Yellen's got a lot of bonds to sell, we should sell off bonds. Either way, as the long end rises and risk premiums rise, this is a headwind for risk. And so, even though I would have preferred my own positioning, because I was negative, to have Powell come in and say rate hikes are on the table. He didn't, but he still was hawkish versus where I think people believed he would be coming into the week after the markets were struggling in the month of April. So to me, that's a hawkish two-step, right? That is the Treasury coming in hawkish, and that is the Fed coming in hawkish. To me, the put strikes for more liquidity from Treasury and the Fed are struck at lower prices than here. Now, risk assets will search for the levels where either one of those organizations become more uncomfortable. And I think that leads to a very precarious setup for risk here still over the course of the next couple weeks.
Okay, so we have ISM jolts tomorrow, non-farm payrolls on Friday. Before we get into the rest of the macro stuff, I want to just talk a little bit tactically about this session today, because I'm running the live trading room in the morning, and then I open it up at from 2 to 3 in the afternoon, always on Fed Day for members. And it was pretty apparent, right, that the dollar was the big lever that was being pulled. So this is on a 2-hour chart, just to kind of give you an example. We broke right through 106, and as we fell, of course, gold went up. But I mean, equity markets at the time were forming this beautiful, this is the Q, I've got Qs and SPY all together just to kind of show you how parallel this all is. They were really doing a great job of coming back inside this trend line. It made a lot of sense that we were going to have a move higher. I basically said in the room, the market wants to bounce, just let it. But all eyes were on the dollar. Yields, yes, the 10-year softened, and forget about oil that had already been dumping. But this was it. I mean, I'm like real time watching this. It was absolutely the lever of the dollar falling that put a bid in equities, and we moved 70 points in a New York minute. Not quite a New York minute, but we definitely rose right up, into some resistance levels, specifically SPX 5080. That's a really big kind of dealer level where they're dueling it out. But I want to get from you, what do you think was the reason the dollar dumped? Because that was the lever that I saw that caused this pump. And then what was said to reverse that on a dime?
So a couple things. First off, now that we're speaking live, it looks like there's BOJ intervention going on right now. Dollar yen has moved from 157.50 and change to sub 101 to sub 156. That's a pretty big move after hours. So I don't know what's going on there. Maybe they felt like who knows if this is real intervention or if this is stops whatever it is. But
this is actually the real intervention. So let me just kind of post something. Bring something up for you real quick. I should say for those who are attending. Let me just find it real quick. This was, I will get there. Yes, predicted, in fact, by Weston. Let's just do this screen real quick and show folks what the heck we're talking about. So we just get on to May 1st. This is the dollar yen that Craig is referring to. So some intervention. They did try. Actually, let me just kind of go over here. Here's the dollar yen on the daily. I just happen to have the JGB 10-year yield over here. When this was ramping up into 160, they did, it looked like an intervention on Sunday evening before a bank holiday in Japan Monday. And it was actually interesting. Weston, who runs a fabulous Substack, and I've retweeted him several times, said he didn't think this was actually the MOF. He really thought this was just thin liquidity on a Sunday evening. And most likely they would come in a few days and do the real intervention. So he was spot on with this. But anyway, that was done when? Because that was not during the Fed, during Powell's conference.
No, it just hit. It
just hit. So I'm
10 minutes ago after the close. Look, this is if this is the BOJ, which it very likely could be, this is in a lower liquidity point mark after the Fed, after Treasury's announcement, when the market's closed here in the US and people are sleeping, like everyone's had a long day, and then all of a sudden somebody comes in and sells a lot of Treasuries. Now look, I mean, in order for Japan to strengthen the currency, they need to sell dollar assets. So either they're selling treasuries or they're hitting their swap lines or something. So it will be interesting to see. I see yields are reacting. Yields are moving higher. So if this is a scramble move by Japan to sell treasuries, it's just going to add more pressure on the long end. And that's kind of what we're seeing right now, is that the long end is selling off more and 10 years selling off, even 2 years are selling off. So there's definitely an element of that going on. So we'll see. It's very timely and kind of just adds to the craziness, and probably means, my ability to go to sleep tonight's going to be even that much more reduced. But as far as your question about the dollar,
yes.
What I had been seeing, and talked about this a little bit, was that positioning long dollar into today was very, very elevated. I've been a dollar bull, for a while, all year, dollar yen, dollar RMB, dollar EMFX, dollar basically everything. And it looked as though, look, I think everybody has got pretty, pretty bullish in the dollar from a rates and from a growth differential perspective. And so ultimately, look, I think that the intraday reversal just had a lot to do with positioning, and the fact that folks are kind of positioning for a hawkish Powell. They didn't feel like they got that, and so I think it was alleviated to some degree kind of intraday. I don't really think anything else, but now with this BOJ stuff after hours, but I don't know. It's still hard to. I think it's more of a positioning unwind than
okay.
I
I probably asked you unfairly, but I really thought that was the lever that triggered equities higher and then of course lower again. But there was another thing that he did talk about, which was productivity and economic expansion. That's very much the enemy of bonds in large part, inflation and wage inflation. So productivity really needs to keep pace. And he talks about expansion. I think the dollar was just a reaction to some of that. But nonetheless, moving on, we are still in this neutral space, chop fest actually, with the 2 and 10 year yield curve. You want to talk about this because we still haven't broken higher, which is dovish Fed, or broken lower, which is hawkish Fed. This is crazy.
Yeah.
So talk about that a little bit if you would.
Yeah, I mean, this has been an unbelievable, chart that we've talked about for a while, and it's still kind of I guess it's really like the chart of truth, right? Is it, if when the market believes that the Fed is going to slay inflation and keep yields high enough for long enough, we get flatteners, and we get that chart, those bars moving lower. And then when the market thinks that the Fed is going to kind of not bring inflation back down to 2%, we get steepeners, right? Because either we get bear steepeners. People are like, you know what, they're never going to be able to bring inflation down for a variety of different reasons. And so, look, I think that we just don't know. And the Fed is not really giving us enough in the way, like they're not strong enough. They're not doing enough to bring inflation down, but they're also not doing really anything to provide more liquidity to markets, right?
Oh, yeah, that's true.
So we're just I feel like we just kind of stuck in that range on curve there, until either the economy breaks, right? And the Fed says we're not, yes, the economy is breaking, but inflation's still elevated, and the Fed doesn't address it. In which case, we'll have a massive, even further inversion. Or the Fed basically throws in the towel and says we gotta stimulate here, even though the economy is fine, inflation, and in which case we get the bear steepener. And it goes out. I don't know. I think that's the indifference is still there, and or the undecidedness of the Fed is still there, and I think that's being played out in that range boundness of curve.
And it's kind of inverse to this, which is the global net liquidity. I know you have your own, and there are so many, but they're roughly saying that we get a big infusion during QE. Doesn't even show COVID, but this is October of 2022, and this is October of 2023. And basically, we have been waning in global net liquidity since the beginning of this year. So wanted to highlight that chart. In regards to what you're talking about as well. Okay, so then, by the way, anyone listening, thank you for joining. This is Macro to Micro Power Hour. Samantha LaDuc, Craig Shapiro. We are also open to Q&A if you have questions. Craig has done a really good job of kind of summarizing where we're at with Yellen's QRA, which is a big deal, all eyes on type of thing, but a lot was known. So was the FOMC announcement. There was no expectation of hikes or cuts. And I think Cameron Dawson actually quoted, I'm going to quote her because I thought it was a good one. The bar for hikes is high, the bar for cuts is low, but we pretty much expect a pause for the rest of the year. Liquidity is an issue. Earnings are right now beating, and God help any company that doesn't, because they have been sold off viciously. We have yields that are so far range bound underneath that kind of 4.7 line in the sand. Dollar has been in a big old chop fest for many, many months, but is threatening. Can we talk a little bit about your baseline bet in regards to dollar? I know you said everyone's really long dollar right now, but it's because we're seeing a lot of this risk off in selling of treasuries to raise dollars by FX and central, bank trade balance conversions, and then they're going into gold, et cetera, et cetera. But can you talk a little bit about the dollar headwinds? Because right now everyone seems to be a bull.
I mean, look, I think this might be a good time to just kind of just focus a little bit on the data, because that's what comes in next, right? It's how will the data come in and how will that dictate whether or not what the Fed's going to do, right? We know now what Treasury is going to do. They're going to sell a lot of bonds every week from now, for the next 3 months. It's a lot, and it's not the type of thing where you could really front run that. It's hard for folks to front run that level, that amount of duration. So just like every auction, like we have more. And the question is, are people going to show up and at what price? So then we get to the data, because the data will determine whether or not the Fed needs to be thinking about hiking or never cutting or cutting sooner. And so what we had so far this week is we have had some regional. First, we had the Chicago PMI, and Dallas PMI earlier in the week. Those were abysmal. And then we had this morning, we had ADP, which came in better than expected, which is payrolls. We had the ECI actually was yesterday. That was important. That was the employment cost index that came in hotter than expected, which the Fed has embraced this idea that we've had significant productivity gains during COVID, which may allow us to believe that there's a case for this non-inflationary growth dynamic, and that inflation can, get back down to target without a lot more tightening. And part of that's been driven by, the productivity. Some people think that's AI. Some people think that's from immigration providing more supply to the labor market. But when you get
all the high ones,
when you get the ECI up, at 1.2% year on year in the first quarter versus 0.9% in the fourth quarter, that's reacceleration. Now, yes, part of it is hours but it's going in the wrong direction. And so it's harder to make that case for productivity gains when the employment cost index is moving back higher. Now, tomorrow, I think we get productivity. Yeah, tomorrow we get productivity data. So. And we'll get a revision for last quarter. So there's been. I
thought we had the revision a few days ago for last quarter. It went from 3.2 to 3.3%.
Fine. So yes, so 3.3. Okay. So 3.3 for last quarter. They're looking for zero. Markets are looking for 0.5% for this quarter. Obviously a very muted low number. Well, we'll see. It's very hard to forecast and predict. But I think part of the Fed's comfort in believing that they don't need to tighten more is because productivity has been so robust. And so if there is an issue on the productivity front, where for some reason that number comes in well worse than expected, that's going to throw some more caution to Powell's dovishness today, because and
the flip side though too, if it comes in stellar, then bonds will be happy and rally. So
I think that will be seen maybe more in the middle of the curve, maybe 5s and 7s. I think that's not a reason to get particularly bullish on long duration stuff. But yeah, so tomorrow, the last thing we also got JOLTS already today. That came in a little bit worse than expected. That's for the month of March, but February was revised higher. Look, the labor market is fine, but softening. I don't think this is, particularly novel information. The Fed even said this is like what we expect. So the fact that you're starting to see that a little bit in the data, I think makes sense. I think the Fed would need to see a much more rapid pace of deterioration in the labor market before it got concerned. And I just don't think that we're getting that now. We obviously have payroll on Friday, and that will give us average hourly earnings as well. So look, we'll get another data point on that. But if that comes in hot, we'll have more reason to believe that the Fed should be thinking about hiking. And if that comes in cold, then people will feel more comfortable that the Fed's doing the right thing by not talking about hiking. So we have to kind of trade these these data points now as they come, and they become a little bit binary in my view, right? Hot data is going to be bad, and cold data is going to be good.
I see it in reverse. It's just going to have an algo trigger that's going to unwind soon after, because big picture, they're not going to do either.
Yeah. I mean, these are the just for the day, right? These are the very short term, and whether or not small caps outperform NASDAQ or not on any particular day, and the zero data expiry crowd gets excited or not will be determined. But yeah. again, structurally, stepping back, the Fed put is lower, the Treasury put is lower. There's going to be pressure on risk assets. And then, look, we have the CPI, PPI on the 14th and the 15th of the month. Powell actually speaks the 14th of May, which is the same day as PPI, but it's before CPI. But look, you'll get an update from him in 2 weeks, right? After he gets to see all the data, and he could, decide and say, you know what, yeah, maybe I was wrong about a hike because we need, who knows? But broadly speaking, I think the momentum is for pressure on risk assets that is still dollar up, yields up, equities down.
Okay.
That's the framework I'm still.
All right, let's answer a few questions. What's your take on stagflation? GDP now shows good growth, but recent reading came in only 1.6%. And this is one thing that the bulls absolutely need. They need earnings, and they need economic growth. It's two peas in a pod. So earnings expansion. And in fact, they really are expecting a 20% EPS acceleration between Q1 and Q4 based on economic growth. So let's talk about that data and then stagflation in general.
Yeah. Look, I mean, Powell was asked about stagflation. He kind of laughed at the question. Because he's like, well, I lived in the 70s, and that's when we really had stagflation, because we had, near double-digit unemployment and, double-digit inflation. So talk to me when, now we have inflation at 3% and unemployment at less than 4%. Like, that's not really stagflation, guys. Like, what are we talking here? But look, this is a rate of change argument, right? I mean, and I think that is how markets will trade. If we have slowing growth momentum with sticky inflation, well, that's stagflation. It's is it the same degree of stagflation that we had in the 70s? No, but it's still a stagflationary environment. And look, the truth of the matter is, for the common American, no one believes the CPI numbers anyway, right? People are not,
or 50, BLS for that matter.
Over 50% of the readings in the PCE are showing inflation that is above 3%, and like 20% of the readings are showing it above 10%. So people are experiencing real inflation that is greater than whatever Powell wants to tell and gaslight people to believe that the inflation is 1%. But that's not here nor there. But yeah, look, I think we have a stagflationary environment developing, one that makes it more difficult to have the Fed react in a way that they can provide liquidity. If inflation is running higher than target, reaccelerating higher than it should be, they just will have to be slower to react to this deceleration in growth. And look, it's not even as if it's like the growth data and the consumption data is on the weaker side, but the labor market is still okay. So, again, I just think that stagflation means it's harder for the Fed to react. And depending on which segments of the economy you're in as a company, you're getting hit bigger or more or less, right? And so certain types of equities will work in stagflation. Typically that's materials and energy that could do better, particularly if commodity prices are holding in there. And in consumer stuff, I mean, we saw, Starbucks was obviously kind of top of mind, some pretty horrible commentary about the consumer. So I mean, consumer facing and, are not going to be particularly well received in a stagflationary environment. So
Starbucks was actually a really good case study, though, because a lot of companies, while inflation was accelerating, were able to kind of dictate price. It was over volume. Volumes were falling, but they were still able to hit top line revenue because they were increasing prices. So it was price over volume. And then this, past Q4, Q1 is very much about cost control, margin control. And those who are executing on that are doing okay. But God forbid, they're losing on the price front, they're losing on the volume front, and they're losing on the margin front. That was basically the triple whammy with Starbucks this morning. So it was a big, and that's what I meant by God help the companies that are missing on those metrics, because they are getting viciously sold. So it is a testament to the consumer is pulling back. McDonald's even talked about that. But that is, that prices are still sticky, start a part of the stagflation. You don't see any deflation yet in prices or inflation coming down, even though oil has. And that's actually kind of a nice rollover candidate. Do you have any look? Commodities right now are also pulling back, gold and silver, which was not a surprise, right? We had kind of that benefit early on of saying, hey, yields can get very, very firm and commodities can take a pause. And that's exactly what happened. So we were kind of prepared for that. What's next in regards to the 10-year as it relates to events here that can really start to trigger some unwind or some rate of change increase, since that's really the focus now?
Yeah, look, next week we have auctions, right? We have a 3-year, 10-year, and a 30-year auction next week. They'll be at the sizes that they were last time. Neither of those, none of those were, look, the auctions are okay, went okay, but the yields are higher. Right. And so everyone's kind of focuses on, on the grade of the auction at that particular point in time. But, kind of step back and look, if you bought into the last auction, you're losing money across the board in all those auctions. So, now investors that are looking at more supply coming are going to expect kind of higher concessions for, to take down that supply. And given the data that we've seen this week so far, labor data good, ISM not so good, but prices paid 60.9, which is the highest reading we've had in 22 months. And back in June of 22, the Fed was, raising rates at 75 basis points. Now they're still talking about cutting. I mean, so I don't really see a great bull case for bonds here. I think we're going to continue to see a grind up in yields. And if the labor data and the ISM services data are strong on Friday, I think we're going to get, 10-year yields are going to make highs for the year here, back, above, probably make it, move above 475. And there'll be folks who are talking about 5% again. Now, I think that pathway from 475 to 5 is probably one that takes equities down from 5,000-ish to, 4,800.
November 1st.
4,800 to 4,600 to, so there's a little bit of interplay there, right? As the equity market falls, there may be an out of equities into bond kind of rotation. So, but all else equal, I expect yields to keep grinding higher as long as the data coming in as it is. And that's going to keep putting pressure on equity.
So there's a question. Do you think the Fed and Treasury will continue to stimulate the economy on any weakness, especially because it's an election year? Will that drive another move up in markets? In other words, what would be the bullish trigger for moving higher? I'm also asked this someplace else. I definitely see the market hitting 5,200 SPX and the Qs at 445 before we have a proper rollover for those who are tactically positioning for the next big short. I think that's a better level at which to enter. I am not bullish, into what others are seeing as kind of a resumption of a strong market strength. I had 5340, at the beginning of the year, and we just rolled over right before it. So now I don't think we're going to go tag it, long story short. So I'm looking for the bull case of how to get back up to 5,200 and 445 Qs. You got anything?
Nope. Look, I think we are finally we're in sell in May territory here, right? We are to me, this is the worst possible setup for risk assets, because you're still going to have the data showing positive momentum for the month of April, where the labor data comes in better than expected, and the inflation data comes in better than expected. And you just had basically Treasury and the Fed kind of tell you that the puts, the strike prices of their puts, where they're going to provide liquidity, were not here. We just asked them, and they both said no. And so as the data gets better, that means that's even worse. That means we're moving even further away from receiving the accommodation from the Fed. And I don't think that tapering of QT at 30 billion, I don't think that's just a big enough big enough thing to matter. So what I expect over the course of the next couple of weeks here, a pretty violent move lower in equities. Wouldn't surprise me if we, breached 4,800 and went back to flat on the year for S&P, in short order, because I don't see really what the positive catalysts are. I think we're going to get better than expected data, and that means that inflation is too hot, which means the Fed is on hold for longer, and Treasury just told you what they're doing for longer. And where does it now, outside of the US, are we going to get stimulus in China? Are we going to get something out of Japan that makes people want to buy? I don't see that being a big enough driver for US stocks. And so now,
but you're not ready to call.
Yeah,
but you're not ready to call a stagflationary recession, though, anytime soon. We haven't gotten to that point. Credit is still, doing its thing, nice and tight, expecting an earnings blowout between now and the end of the year on economic growth. So you're
I think
just
when we get
talking-
right, yeah, I think look, I think it's possible that when we get equities down enough, we're going to start to hear more about layoffs. We're going to start to get more pressure in the labor market. We're going to start to see credit moving wider, and that will kind of bring in, you know, recession. And when the Fed then decides to cut rates, it's not going to work, right? It's not going to be enough, and they're going to have to cut more than anybody thinks. So I actually probably think that, you know, buying Z5, SOFR Z5, you know, is only looking for, you know, I think four cuts, you know, in the next 18 months or 20 months. That's probably too low, because if we actually do get what I think the pain is going to be on the equity side, the Fed's going to be it will impact the economy. And, you know, it probably means that the Fed will be forced to doing more cutting next year. But that's more of a...
We got to get there first.
We got to get there first. Exactly.
Okay. So I have a kind of I do see this fulcrum point where this large government spending is clearly, you know, stimulating the economy, and there's a lag, but it's also very inflationary. Rates stay high. If we do get above that, you know, I've got this 4.688 to be specific, but let's just round up and say 4.7. And we do that soon, then the rate of change picks up and we're going to actually move into 5.3 pretty quickly. That was not my baseline bet until the end of the year. So it's been pulled forward, which means the intervention tricks are failing, long story short. And you've just, you know, given all the rationale around knowing really what Treasury and Fed's going to do. But as the rates do stay higher, it does start to crimp company margins. It will start to hurt bank lending. It'll start to also put a headwind on this economic expansion. So it's really just a matter of time before banks start to show, earnings start to show, companies, you know, a little bit more bankruptcy, which we, by the way, have had quite a bit. And then, of course, it all shows up in the employment, but that lags. So we're really looking for those trigger points. And right now, high rates are my number one tell. So I'm very focused on that.
I guess maybe even said more simply, I think the economy is probably turning over right now, and the Fed and the Treasury just told you nothing we can do about it.
Yep.
And so, or nothing we're going to do about it. And so and look, at these prices, again, it's about looking for the put, about looking for the strike price. We're not, not here. And so, if the equities fall 15% in the next 3 weeks, you're going to start to hear about the Fed cutting rates in June. Right. And then that's going to come back into the narrative. But we have to get there first. And if we don't get equity prices and risk prices correcting, then the Fed and Treasury they're not going to do anything. They're not going to give the liquidity.
Okay. So let's talk a little bit. I have a chart I want to show. Hold on one second.
Now dollar yen is 153.40.
Holy smokes. That's an overshoot. That's not a little one. That's a big one.
So
okay. Hold on.
They're really going for it.
That's actually very disruptive. So, hold on. I want to show a chart just in talking about, I don't even know why, it just kind of popped up to my mind. Oh, let me get this out of the way. All right. You see this S&P election year seasonal pattern? Is it showing up okay?
Yep.
Okay. So if anyone's curious, Craig is hands-on, all things macro, obviously runs a book and talks about that with clients and populates his Slack channel. There's lots of analysis on narratives and data interpretation. One of the things that I do for clients besides a live trading room is this intermarket review. And it helps, and there's a lot in it. But anyway, it's from options to, all my funky stuff, sector rotation, volatility, bonds, ratios, up the kazoo. It's a lot. But one of the things that I just showed recently was this seasonality chart that has us selling off a little early. Usually it's kind of as Craig said, April's not really winning any awards, but down into about June, and then June we tend to pick up higher. Again, this is just seasonality. Doesn't mean it's going to happen, but it's kind of like, it's good to know about it because historical data tends to repeat. So when I was asked here in Q&A, what about my price target? I gave that 53.40 early in January, right? And then I pulled it back. And specifically, it was because gold started freaking out higher on March 1st. And I said, that's it. The NASDAQ is done going up. And sure enough, we have rolled over very strongly, not because of the seasonality chart. I just found this like yesterday, but My point is we have started pulling back in NASDAQ, and that was actually one of the reasons why I got this kind of stalking a market top in March and then rolled over very nicely timed in April. And the fascinating thing was that we were all aligned on this. So Craig and Jeffrey and myself, we were all aligned on this. So how long this lasts, I don't know if it's violent or smooth, but into June makes sense because we have a big nut to crack, and that's NVIDIA on May 22nd. And even Meta, which was as good as it gets kind of earnings, it still sold off violently afterward. Even Amazon, which was stunningly gorgeous, isn't getting back above the all-time highs of 188. So you can see what happened to Microsoft. You can see what's happened to Netflix. My point is that the generals are falling and the breadth is atrocious under the surface, which is something I really micro study. So if breadth has broken down during all of March, gold and silver are still fine, big picture. And then you've got all of this, there's not a lot of bullets left by Fed and Treasury. We kind of know what to expect. It is very dangerous to expect that we're going to have a bullish rampage higher when bulls are betting on lower yields and we don't have it, lower dollar and we don't have it. So really their whole base case is earnings are going to delight and because of economic growth. So any data that we see that negates that argument, right, in earnings and in economic growth, it's going to be harder for bulls to get going, to really bid this market up. That's it. That's basically, I don't see it moving higher. I think we might tap 5,200, but that's it.
Yeah, I mean, look, that seasonality chart, I didn't even realize that, and it fits very well with
it does.
With my view here about the next 1 to 2 months, being very challenging. And look, that kind of brings us into the June meeting for the Fed, and if things are reeling into that, and markets are on the fritz, and vol is elevated, imagine the Fed will come out and talk about what they could do, right? And that, yes, finally we are seeing some signs in the labor market, blah blah. So, but we have to get there first. We can't trade ahead. Can't trade ahead of that. I think we got very important data points this week from Treasury about what they're going to do, and Yellen is not this political animal that is going to pump liquidity into the markets and into the economy in the third quarter. And we learned from the Fed that, yes, they still believe that inflation is going to come back down, likely driven by housing rolling over, but they are in no rush to cut. They're also in no rush to hike. So, okay, they're in no rush to cut. And as the data comes in, if it comes in hotter than expected, that means, less likely to cut, more likely to raise. And if it comes in worse than expected, they're kind of, we kind of are where they are. So I just think that setup is poor for risk taking here, and I'd be very cautious.
All right. So any other questions you see in Q&A that you want to address, Craig? I'm looking for something while you're doing it.
That's about the yen. So yes, we're looking at the yen. I mean, we'll look, I think I've written about this and talked about this. I think weaker yen is a policy tool. It is the only policy tool for Japan, but they cannot allow it to weaken at an accelerating pace and kind of be disruptive. Mm-hmm. And so when speculators get too over their skis, the BOJ kind of waves them in and then smacks them back. They spend some money. Look, they have a lot of trading gains in their accounts from interventions that they've done over decades, right? And so can they afford to spend some of those proceeds and some of those treasuries here in order to help defend the currency? Sure, they don't want this to run away from them, but I think weaker yen over time is a policy tool.
Yeah.
And as long as inflation,
they're getting what they want, actually.
Right. It's making them more competitive, and it's not being done in a way that is accelerating inflation in Japan. There was some inflation last year, wage inflation, but even more recently, inflation's kind of been coming down again. So I don't think they're at risk of this massive import inflation dynamic that comes from, let's say, higher energy. So I think they want a weaker yen, and they're fine. They're fine with it. And as far as China is concerned, I think China is not going to be devaluing its currency. I know there's some talk about what they have to do, what they will do. I think they're also going to continue to play the long game. They're pricing commodities in RMB. They are settling trade balances in goods and in gold, and they're in no rush. They're in no rush to devalue. I'm sorry, they're in no rush to devalue. They're probably at some point, will revalue, but I think they're just right now buying time. I think the world is actually buying time to figure out what the hell is going to go on in the U.S. election.
Yeah.
Personally, I just think that it's hard to make any coordinated policy moves before the election, because if Trump wins, then a lot of these deals are just going to get thrown. There will be a fear that these deals just get thrown out the window. So I think, for now, these other countries are just looking and saying, you know what, we're just better off weakening our currencies against the dollar here, maintaining export competitiveness, and as long as it's not inflationary, it's good, and we'll just deal with these issues after the election. Because if we have to deal with Trump, it's going to be we'd rather be dealing, from a position where our currencies are really weak anyway, because he's going to make us revalue them, or he's going to put on tariffs or do something else. So I don't think there's really any rush for some coordinated deal, before the election.
And I have to say to all of you who are watching, I'm very grateful that we have a balanced view on this for both yen intervention, which is, again, it's going to what Japan wants and their companies, which are benefiting obviously. And as well, this the yuan devaluation narrative that is just hot fire flames all over FinTwit. But in fact, why would they? So I really like Craig's take on both of those currency reads, because there's a lot of dressing out about a yen carry trade unwind. It will happen slowly. And there's a lot of fear around a yuan deval that happened back in 2015 and spiked VIX up. Again, it's not really to their benefit. So I just think it's really appreciate that we got a balanced view here. It's not FUD. It is very much, why would they? So anyway, just wanted to kind of comment on that. And thank you for your questions. Thank you for your comments. We don't do this all the time publicly. This is Fed Day. We do typically do this on Fed Day. I think we enjoy doing it, even though it's exhausting. I ran 2 trading rooms today, plus the webinar. Craig not only is managing clients directly, but he's got 4 kids and all the earnings and a trading book. So we kind of come to you when we can and on Fed days, but we do this all the time for clients. So this is what we do, like literally actively managing all of the expectations around timeframes and asset classes. And we invite you, if you don't know about our service, to definitely check it out. Edge, Club, and Chase, from macro to micro. And I think we got it going on. We got a great team. And then I basically just wanted to have you comment on anything else that you are expecting, Craig, into the end of the day and the beginning of the month. Maybe Mutual Fund Monday will be productive for a little lift. I don't know. We're looking for bullish cases here. Here. I'm definitely, just to answer the last question on semiconductors, I'm definitely big picture. This is a good short thesis of mine that started on April 15th. And I'm still short semiconductors. I think that's, and very, very bullish gold and silver, but they're having a digestion period.
Yeah.
Long story short. So
yeah, I was going to mention that on gold. I think it's well documented that my bullishness on gold has been, for a while, and I think there's a lot of reasons to be bullish on gold. Gold's had an incredible move. If yields move higher and real rates rise, right, it will be harder for gold to continue to move materially, but it should outperform equities in that environment. And then at the point in time when risk assets sell off enough to start bringing in the conversation again about liquidity, gold is going to take out highs, and I think march towards 3,000 by the end of this year. So still very bullish on gold.
And the miners, even though they're oversold, I have done a lot of writing and talking and setting up of trades around gold miners, because they're definitely going to be much more successful in their earnings with gold and silver at these prices. And some of them are very, very reactive, high beta to price of gold and silver. But overall, it's a really good sector to be in. So cash is also great, right? 5.3%. And yesterday, Yellen's pitching a 6-month, right? Really strongly for 4.7%. So cash is still paying. There's no shame in safety.
Yep. And look, the deficits are going to be here for a long period of time, and the Treasury is going to have to continue to find ways to finance them, and they're going to have to continue to find new buyers for those for that paper, because foreigners are reducing their demand for treasuries and the Fed's not buying. So it's going to be done at higher yields to the private sector, whether it's mutual funds, retail, banks. If it's shorter bills, then it's at a money market fund. So this all comes at a higher cost, and that just means and I put up a chart today where it just shows the gap between kind of current 10-year and expected where 10 years will be versus where the CBO and the OMB have budgeted. And there's just a massive gap between what the government is predicting for 10-year yields and where 10-year yields are. So as that gap gets narrowed, deficits are going to go even higher. And what I've said is, and this is more of a political statement, but I'm not afraid to say it. I think the Fed, has enabled this dysfunction in DC to exist because they never let the bond market do its job. They never let the bond vigilantes come and enact some discipline on the Congress or on the administration. And because the Fed always comes in and provides liquidity when the bond market has any sign of strain. And so the folks in DC get that. They know the Powell put exists. And so no appetite to raise taxes, no appetite to cut spending. Nobody cares, just deficits. Whether Trump gets elected, there's going to be deficits that grow. If Biden gets reelected, there's going to be deficits that keep growing. The only question is who gets the money. And so from a different sector point of view, there'll be winners and losers, but overall deficits just keep going up. And I think this is a major problem at some point for the US. But in the meantime, it means that the Fed has more difficulty cutting rates because inflation has been stickier. And look, we talked about this. Higher rates have been accommodated, right? Because households and corporates have locked in low borrowings, and
they're making cash on their cash.
And the government is the one who is spending money on higher interest expense, and they're giving basically interest rate stimulus to rich people and to companies. And that's
sadly
just,
true.
And that's just being redeployed at different ways into the economy. So the Fed really needs to cut rates, but they can't cut, the Fed needs to cut rates to help bring the overall government borrowings down. By doing so is going to hit the dollar and is going to be even more inflationary. So they can't do that. And they can't raise rates too much because they're afraid that they're going to cause a recession. That is the definition of being boxed in.
Yes.
In my view, they have a solution that they choose not to use. The solution is to be more aggressive on the balance sheet and not do things like tapering, which they just announced. So there's no, they could have been more aggressive on the balance sheet and removing liquidity faster. They could have been more aggressive on selling assets as opposed to letting assets just roll off. They decided not to. And so now they boxed themselves in. And so this is where we are.
And just a final kind of reminder, we have a U.S. government debt to GDP at 97% for as of 2023 end. Government deficit to GDP is at 6.3%. It's come down a little bit from Jeffrey Gundlach's 7.6% back at the lows in October. But the point is, it's extensive. Neutral rate, 2.6%, but many bond investors think it's really more like 3.5% to 4%. So we have a lot of work to do to fix that, and many think it's actually not able to be paid back. So hence, yields need to rise, term premia also. And that's where we're at. It's not very bullish equities, but fiscal dominance is, and they will still keep spending, and we'll see where it goes. But for now, I think we covered everything. Thank you so much for joining us. We wish you a great rest of the trading week. You know where to find us on Twitter and also LaDucTrading.com. Have a great weekend, everyone. Bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro power hour videos and other content.